Hello, good morning, everyone. Welcome to all of you for today's session. Students, I hope all of you can hear me well. So, please do let me know, students. Can you hear me? You have to respond by opening your mic, or you can respond me in the chat box as well. Yes.
Good morning, sir. I can hear you.
Thank you. Thank you. Thank you. Yes. What about others? Good. Yes, please. Can you hear me? Yeah, if you are facing any problem regarding voice, here is the solution in front of you. I need response from everyone. Response is mandatory. Yes. Good. Now, all right, all right, all right. Good. Now, so let me introduce myself. Before we proceed, we should know each other well. My name is Hamzah Siddiq, and I have been teaching ACCA subjects since the last 13 years. And it's been third year of online teaching. And in the online classes, we are, sorry, what happened to it? Just a minute, please. So in the online classes, we are doing it, you know that this is third year, and I have taught more than 2,000 students online, only from Mauritius itself, right? So majority my students, since I have worked there in Mauritius around 3 years. So now, so more than 2,000 students have studied with me. Now, so students, I teach advanced audits for advanced financial management and level 2 papers, financial management and audit as well. Now, I want to know you people as well. So you will be opening your mic and brief introduction, your name, where are you working, or you are not working, you will tell, and whether it is your first time online learning or you have done online tuition before. So we will start with the Ali. Yes, please, Ali. Yes, one by one. We will start the introduction. Yes.
Hello, sir. It's a pleasure to be in your class.
Thank you.
So I'm working in a fund company in Mauritius. I've been working since 5 years, and I'm studying toward my final papers now. So hope to complete it as soon as possible. Thank you.
Good. It is first time online?
Yeah, this is first time online.
Okay, right. Anjana, yes, thank you. Thank you.
Hello, sir. Good morning. I am
Good
Anjana.
morning.
I work in a management company in Mauritius, and yes, this is also my first class online.
Online. How did you come to know about us?
I knew about us from friends, from you
Okay.
about friends.
Okay. Thank you.
Thank you.
Thank you. Yes, Diwashri. I'm sorry if I pronounce the name of anyone in this wrong. Yes, please. Introduce yourself a bit. Yes, you recently joined the class. Yes, Diwashri.
Good morning, sir.
Good morning.
I'm Devashri, and I'm currently doing my level 3. I took my first session for audit and assurance paper with you last
Oh,
time.
great. So
And
you passed the
so
exam?
I haven't yet got the result.
Okay. All the best. Thank you.
Thank you.
Yes, Humera, please.
Good morning, sir.
Good morning.
I am currently in the auditing profession at the BDU Mauritius, and
Good.
this is my first online class.
Good. So, all right. Thank you. So, Jayj. Yes, please.
Hello, sir. How are you?
I'm good, fine. What about you?
I'm fine. So I'm currently working at Apex Group Limited in Mauritius, a management company,
Oh, good.
and I've already did a audit and assurance review, and this is my
Oh,
second
good.
class.
Good. Thank you, Jay. So, yes, Jean, Michael, I think. Yes, please. Yes, please. Would you like to introduce yourself? I think you are in the advanced audit as well. Yeah. And there was also issue. So anyways, so the next is Kavish. Yes, Kavish. Kavish or Kavish, please. We are unable to hear you, dear. I think there is a problem of mic. No worries. So the next is Keshwari, I think. Yeah, Keshwari.
Good morning, sir.
Good morning.
I'm working at a clinic in Mauritius as an internal controller, and this is my first time with your online classes.
Okay,
you.
welcome, Keshwari, welcome.
Thank you.
Yes, Kushma, please.
Good morning, everyone. I
Good
am
morning.
currently working in a management company here. Actually, I had already done the advanced audit course with you.
Oh, good. Thank you. So Minakshi, yes, please. Minakshi, please introduce yourself. I think there is issue at her side. Yes, Nuseha. I'm sorry if I mispronounce it. Yes, please.
Hello, everyone. I'm Nuzaiha, and I work in the public sector in Mauritius. So I've done F8 with you, and I'm waiting for the
good.
results.
Good. All the best. Yes,
Thank you.
Shahir. Welcome, Shahir.
Good morning, sir. First of all, my
Good morning.
sincere condolences for your dad. We got the email
Thank you.
last week.
Thank you.
Well, I am currently working as a fund accountant at Apex Group. I've
Good.
completed all my level 3 papers. That's my final one, and it's my first time online with you.
So all the best for the
Thank you.
online. Simran, yes.
Hello, everyone. Good morning, sir.
Good morning.
I work at Rogers Capital in the taxation department, and
Right.
it's my first time online.
Oh, good. So thank you, Vijendra. I'm sorry.
Hi everyone, I'm Vijendra Bhuvan. In fact, I work for my own landscaping company. I started with the CS long time ago, and
Okay.
I haven't been to complete it because of unforeseen circumstances. And now I have decided those. I have free
Good.
papers. Thank you.
So welcome back to ACCA.
Thank you.
Yes, Yashi. Yashi, you group or you group. Yes. I think there is issue. Yusuf, yes, please. Yusuf.
Hi, sir. How are you?
I'm
It's Yusuf.
Thank you.
Actually, it's my first time with you online. So I'm basically in the accounting and consulting, investment consultancy field. And basically, it's my only and last paper to complete out of ACCA. I had like a break of 2 years due to personal commitment and constraints. So now I'm just trying to clear it off my desk.
So all the best, dear Yusuf. I hope you will do this time. Yes.
Okay, thank you very much.
Yeah, thank you. Yushra, yes, please.
Hello, sir. I am from Mauritius, currently a student from the university and parallelly pursuing my ACCA. I just completed my level 2.
So good. So you are doing a full-time student, right?
Yes. Yes.
Okay. Thank you. Thank you, everyone, for a good introduction by you people. So we are starting our discussion on advanced financial management. Students, advanced financial management, before coming to this subject, I would, majority of you are going to attend class, a live online class for the first time. So I just want to discuss with you a few things, generic, which are important in my opinion, right? So let me connect my iPad with this computer, my laptop, so that I can discuss things in a more convenient way. Now, so yes, here we are. Here we are. So just a minute. Just a minute, please. It is getting connected. Yes, I trust this man. Yeah. Yes, here we are. So, students, remember, advanced financial management, as we know, this is the subject which is from FM in the level 2, the advance of that. And if you have forgotten what you studied over there, normally it happens, students say, we have forgotten what we studied at FM. So I usually tell my student, don't worry, because whatever we'll be discussing over here, that will be from scratch, that will be in detail. That will not be something like that. You will be missing something, what you have studied before. So you will be doing everything from scratch over here. Advanced financial management, in my opinion, and even in the opinion of some of the tutors, which with whom I studied, long ago, that if you are doing ACCA and you are not studying AFM, you have not tasted finance appropriately. And since you are going to work in the finance departments, and without AFM, you can be a good accounts manager, but not the finance manager. Means finance. If you have to have a good understanding of finance, you must do AFM. You must do. AFM is a very interesting subject. Let me tell you. I am more known for advanced audit. I love teaching AFM, and you will enjoy it as well, right? So, but there are a few things which you should keep in your mind while attending classes. The first thing is, let me ask you people, have you received the course plan and the notes volume 1, everyone? Have you received?
Yes.
Good. Good. So course plan, we have provided you people, which elaborates that how course will proceed. Students, since AFM is the optional paper and the one of the final papers of ACCA, so it requires strong analytical skills, good command on calculations followed by analysis. But AFM, you have to plan your studies as well. Since we are heading towards exam in June 2022, I suggest to you, yes, sometimes student says, I will study for the June exam, but will attempt paper next year. Please don't do that. AFM has so many tiny points that yes, if you want to delay, you can go for September 2022. But remember, do not think to delay beyond that AFM exam, because there are so many points that, in my opinion, if it is normal for every subject, that when you delay paper, you miss a lot of things, you know, as compared to if you are doing it on a regular basis along with classes. So students, advanced financial management, this subject, it requires around 140 to 180 hours self-study. When I say 140 hours minimum, what I mean is that if you want to pass your paper with confidence, I believe in the phrase, you have heard that phrase before, that if you are not over prepared, it means you are under prepared. This is what I believe in. So I want every one of you to be over prepared for this subject. And for that purpose, minimum, this is what you should plan to be over prepared. Otherwise, some students, they prepare 60, 80, 100 hours. And by luck, by chance, they pass as well. They pass as well. They get good marks sometime as well. So this is what I want you to plan your studies. And if you see 140 hours, if we divide it over 5 months, okay, how many hours per month they are? They are around, yes. How many? 20, how much? 28? Yes, 28 hours per month. And if you see, it is around 6 to 7 hours per week. 6 to 7 hours per week. And this is the same for each subject in the level 3 papers. Normally, 6 hours are normal, you know, to be studied. So students, that's why you should start planning. You should start planning and allocate time. The way I have given you the course plan, here is the course plan. You see here, today is 16th. We are starting it today. And these 3 are additional classes. Additional classes. Total 19 classes there are. They have been scheduled. So 19 means 19 cross 3. It is around 57 hours. But let me tell you, if needed, I can extend this 3 hours class to 3.5 hours class. I can extend that. Now, so you should keep in your mind So it is starting, instead of 8, it is starting today, 16th Jan. Now, so students, this is the first thing. The second thing, in order to do this, we want to achieve this target that we study on a regular basis. The first and the foremost thing is that you have to, the first and the foremost thing is that you have to regular in class, live class. Because if you are not regular in the live class, remember, you will, what you will do, you will say, I have access to the video recording. And you see here, per week, there are 6 hours here, 3 hours class, 9 hours per week. If you miss 1 week, you get 9 hours burden. Okay, second week, 18 hours burden, and things get piled up. Normally, the reason, I know Mauritian students very well. I have been teaching them since 2013. Yes, 2013. It's 8th year, but the 9th year started. I am teaching them physically and online. I have been taught them that what they do is when they miss things, then they say, okay, we attend class, we miss class, that's equal for us. Sometimes they come, they attend, then they go back to home and they don't prepare. When you get disconnected from a routine, ultimately, then it is very difficult for you. Difficult, I'm not saying always. Sometimes some students get medical issues. So it is a genuine thing for them. Yes, they get disconnected now. So let us proceed further. Let us proceed further. So then, so these things should be clear to you people, that how we are going to proceed. So students, these 2 things you should ensure. Prepare every lecture every week. Now, as you have seen the course plan, and you see a lot of practice we have to do. Even during these classes, I will be solving small examples where practice have written. It is again basically long questions we have to do now. So students, AFM, come to the syllabus. Before moving towards syllabus, one thing should be clear to you people. ACCA have made it very easy for you by introducing online Excel access. ACCA has made things very easy. I repeat, by introducing online Excel sheets and typing word option where you have to solve the exam. Now, exams are, because some people are joining after a gap, it is for them as well. Because before this, a lot of time used to spend in the calculations, which are now easy. You can do calculation. You can do calculation now. Simply Excel will do it for you. So you save a lot of time in that. You apply formulas, you solve things over there. Now, so when we talk about syllabus, the syllabus of AFM, there are 4 grids. The first grid is, the first grid is International Advanced Investment Appraisal. Advanced Investment Appraisal. The second grid is, that is, mergers and acquisitions. Third grid is corporate reconstruction. And the fourth grid is risk management. And fifth grid I add from my side, and yes, that is theory plus examiner articles. This is the whole syllabus. This is the full syllabus of your AFM. And remember, student ask which, sir, is there any tip we can do some selective study? Please, no selective study at all. Total 1, 2, 3, and 4. 4 sections are there. And normally examiner test all 4. Even this as well. It's quite rare you will see any past paper where examiner gives any question, any area. And there is no choice. When there is no choice, how can you think of selective studies? How can you think of selective studies? Yes. All right. Here we are. Students. Yes. So this is the investment appraisal, the first section. Yes. So which has this much. This is the first volume which covers only investment appraisal. This is the investment appraisal only. So that's why we have to, and this is the major area, means if you study investment appraisal properly, it will help you in merger acquisition, in corporate. This knowledge, it becomes a base for that. Yes. So I'll be providing the notes, exam kit, practice questions, whatever is required to prepare for exam. Moreover, I will WhatsApp group I will make today. I will share the link with you people. In that WhatsApp group, every week after the class, since we will be doing working in Excel sometime, Excel sheets. So I'll be sharing those Excel sheets in the WhatsApp group. Right? Any question from your side? Tell me. Any question from your side? Good.
Hello, sir.
Yes.
Just trying to figure out. I mean, what's the? I've got a course plan up till January or February. What is the target date for completion of the whole syllabus?
Yes, course plan is here. Let me show you. Here is the course plan. Yes, you see here. 1st May.
1st of
is
May,
the
all right.
course completion detail, right? So you will have, I said 1 to 2 educators can be used or recorded session.
Yeah.
For example, recorded session for what? Normally for theoretical discussion. Okay. So I can arrange. Okay. As per the need. Again, it is not mandatory. Okay. If needed, I can arrange that. Means I will arrange the recorded session and will provide you that, and you can watch that as per your own convenience, recording of those sessions if needed. Again, if needed. Okay. So the course completion date is 9th 1st May, so that you people can have 1 month for preparation and the crash course if you want to attend as well. Okay, so it is like that. So yes, so students, anyone, any other question, please? I appreciate. So you see here, should I proceed further? Yes, please. If it is clear, no question, should I proceed? Okay, yeah. So this communication is very much important from your side. Very much important communication. Because in the online class, there is one constraint that I cannot read your facial expressions. Okay, so you can open the mic better. I prefer communication by you people via mic. Open that and talk to me. Okay, I prefer that. Now, next. So let us proceed further. Let us proceed further.
So before proceeding, one quick question for the additional classes on the 15th, 22nd, and 20. It's during the week, right? So these,
Yes.
what would be the timing of these? Would it be in
It
the
will be
evening?
the evening timing. After I think it will be 6:30 p.m.
Okay.
Okay, this will be the timing. Okay, after 6:30 p.m. Now I know the office timing of the people. They are normally it take time them to reach at home even after office. Yes. Now, so students, so let us proceed further and start today's discussion. Students, investment appraisals. We are going to start investment appraisal. Yes. So students, investment appraisal, when we talk about that, the companies, they evaluate investment before they invest the funds over there. They evaluate. So evaluate, if they evaluate, of course, they have to decide whether to launch the project or not. Now, how to evaluate investment appraisal techniques? So in our syllabus, these are the techniques. 1, 2, 3, 4, 5, 6, 7, 8 techniques are there. They are part of our syllabus. So discounted cash flow techniques, non-discounting. So what they are, I will talk about it shortly. Now, so non-discounting cash flow techniques, what they are, which ignore the time value of money. Do not consider, there is no discounting or compounding. Okay, so the first of all, let me proceed further. So let me proceed further over here. Accounting rate of return, ARR. So just a minute, please. Yes, since we have different examples, so I have just opened the Excel sheet. Yes. Now, so students, accounting rate of return, most commonly used, it is also called accounting rate of return. It is also called ROCE, return on capital employed. ROCE, return on capital employed as well. This technique is the only appraisal method which is profits based. the only appraisal method, which is the profits based. Now, so students, how it is calculated, how ARR is calculated, you should know the formula. So just 1 minute, please. 1 second, please. Let me open the notes here as well. Yes. So here is accounting rate of return. Return on investment rose. So percentage return on investment. What is the return? How much percentage we are getting? So it is calculated by average profit divided by average investment. Yes, average annual profit. And how it is calculated? The full profits of the company for the project life. For example, 5-year project. We add divided by number of years. Average investment. Investment is initial investment plus scrap value. So divided by initial investment plus scrap. A few things I will type. I would suggest you that you people note down those things, please. Yes. So ARR, actually we are calculating the return generated by the project. The return generated by the project, we are calculating that. So students, ARR, accounting rate of return, how to calculate that? Let us learn the calculation. Yes. So for example, a project has initial investment of, that is 2,500 million, and scrap value will be at the end of the project will be 275. Life of the project, for example, profits are forecasted as follows. Yes. For example, that is 320, 377, 415, 439, and 520. So how to calculate ARR? We have to calculate average annual profit first. How to calculate? Sum from here to here. First of all, they are the total profit, total annual profit, total annual profit. Yes. Now, average annual profit, so is equal to this divided by number of years. 5. This is the average annual profit. Now, average investment equal to this plus this divided by 2. So average investment is here. Average investment. Yes. So now ARR is equal to average annual profit divided by this, multiplied by 100. multiplied by 100. Here we are. So 29.85% is the ARR of the project. Any calculation you want to see again, don't hesitate at all to ask me. I can elaborate the cell like that you can see it. Yes, please. Is it clear? ARR calculation is clear?
Yes.
Good. So now, students, point is ARR of the project is greater than target ARR of company. Yes, what decided? What we do is we accept the project. Yes, company say we accept the, for example, in this case, target ARR is, for example, 20%. So we should accept it. But if target ARR is 35%, we cannot accept it. We cannot accept it. Now, so students, now ARR, advantages and disadvantages. Advantages of the method and disadvantages. Advantage is that it is simple. The first advantage, that is simple, easy to calculate, as data is readily available, can be easily allocated, calculated. The second advantage, it links in return with investment. Yes, that how much percentage we are getting. So helps in making a decision. Yes, helps in making a decision. Yes. Now, so ARR, it considers the whole life of project. Yes, it considers. So these are the advantages, but it has certain drawbacks as well. The drawback is that it is profits-based technique, which are subject to manipulation by changes in estimates. Changes in, now what does it mean? Means you can change profit by changing depreciation, provisions, non-cash expense. Yes, it ignores time value of money. Considers. So these, what I am typing, this one, I have to note down these things. Excel sheets I will be sharing. You know, if you note down, you will involve in the lecture more, otherwise you will cut off. Now, so if you have to note something, do tell me, and if you are unable to note that, do let me know. I will go back to the page. I will give you time to note down. It ignores time value of money. Have not done any discounting, with simple averaged out. This is what I will share. Now, it ignores time value of money. Yes. So these two are the major drawback. Yes. And the third, it ignores the size of project. What is it? Size. Let me explain it. Students, a project A and a project B. It has ARR of 35%, ARR of 25%. As per ARR, A should be chosen. But profits, if we see total profits, yes, for example, they are 25 million and they are 300 million. So investment size, investment here it is, for example, 40 million. And here investment is, for example, 500 million. So based on ARR, we cannot decide when we have only this knowledge, this one only. We cannot decide what is the size of the project. It is just saying except this small project. Bigger size project have other so many benefits, so many things attached. Amount of profit is too great. So it ignores the size of the project. I hope it is clear. So it is done. Now, so ARR is done, but there is one technicality we have to add. Students, example 2, ARR. Yes. For example, initial investment of the project is 3750 million. Scrap value is 390. And these are the profits. This is for you people. 420, 535, 890, and 970. Calculate ARR, everyone. Give me answer. Be quick. Give me answer. Calculate ARR of the project. Be quick. I'm waiting for your answers. Please. Be quick.
34%. 34%.
That's correct. 34%.
Good. So average annual profit this divided by 4, and average investment equal to this plus this divided by 2. Yes, so ARR. This divided by this. Exactly, your answers are correct. Now, so example 3, some complexity. I said it is profits based, but in exam you given sometime you get a complexity. Sorry, example, yes, 3 ARR. That is cash flows adjustment. Yes, they say that, for example, you are having initial investment that is 4,000. Scrap value is that is 410, and cash flows are given as follows: year 1, 2, 3, and 4. Cash flows are given, not profits. And the cash flows are, for example, is 890, 920. Sorry, I missed here. So make it 1100. Make it 1320. 1490. And for example, here it is 990. So these are the cash flows. They say calculate ARR. Now the point is how to calculate ARR from here. We cannot, there is profits. So remember, cash flows are equal to profits plus non-cash expense. That means profits is equal to exactly is equal to cash flows minus non-cash expense. Then we get that. And here non-cash expense is depreciation. Can we calculate depreciation from here? Yes, we can. Depreciation, how? Initial investment is this and scrap value is this. It means difference is depreciation. Initial value is investment is this and scrap value is this. Depreciation. Initial value minus scrap value. Scrap value is the value at the end. And the other is value at the start. Depreciation. Now profits of the project equal to sum from here. Sorry, these are the cash flows, total cash flows. Yes, now profits. So you see here, cash flows minus depreciation. Yes. So average annual profit, this divided by 4. Average investment, this plus this divided by 2. So ARR, this divided by this multiplied by 100. Here it is. Percent. So the whole story is in front of you people. ARR is done. Any question? I'll proceed towards the next method of investment appraisal, payback period method of investment appraisal. What is payback period method? Payback period method is here, given. Time taken by a project. Payback its initial investments. Initial investments. To repay, if I read, to repay or recover its initial investment, that is called payback period. This is the first thing for which normally investor is concerned about. That I am going to invest, how much time it will take to recover my investments? Initial funds. How much time it will take? This is the first concern. So, or because I am, for example, I have arranged funding from the bank. The bank have given me loan for 4 years. I have to repay. So the amount I am investing, whether the project will repay me in 4 years, if yes, then it's good. It's good. Now, so let's see here. Payback period method. How to calculate? 1, 2, for example, I will take the same cash flows. Yes. Yes, so here is year 0. Here is year 0. Yes. So students, investment is, initial investment is how much? 4,000. Okay, 4,000. So negative 4,000. Negative 4,000. So these are the cash flows of the project. Now payback we have to calculate. So we make cumulative cash flow. Cumulative means total to date. Negative. This plus this. This recovered. Remaining are this negative. This plus this. This plus this. Now you see here. So 3-year complete. We need 90. And here are 99. It means part of year 4 will be utilized. Part of year 4 will be utilized to attempt to recover this amount, not full year 4. How much part? We need 90. How many there are? 990. This is the part of a year. So 3.09 years. Or you can convert it in months as well. 3 years and how many months? This into 12 months in a year. 1 month. 3 years and 1 month. 1 month. This is the payback period of the project. Now, calculation of 0.09. Okay, here it is. $90 we needed. Here's $990. Next year. Okay, now, so should I proceed further, everyone? Is it okay? So advantages, please note down these advantages of payback. Payback. The first is it is cash flow based. It is a cash flow based technique. Cash flows based technique. Yes, which are more reliable. It helps to reduce the risk investment by recommending projects with shorter payback period. Means, of course, the product will have smaller payback. We'll accept that. Yes, student, it has so many drawbacks as well. Yes, disadvantages. It has so many disadvantages as well, which are quite, we say, quite important. Now, what are the drawbacks? Friends, at first, it ignores the time value of money. Yes, no discounting. We consider the same amount every year, same value. The second, it encourages the short-term focus of business. Yeah, because it says accept the project which is shorter payback, no long-term project. The next point is it does not consider the full life of project. That is, it ignores cash flows occurring after payback period. Yes, it does that. What is happening after 3.5 years? For example, there is another project. It is here. There is another project. In which year 5. Here is, for example, 20. And here is 360. And year 6. Once again, cash flow increase goes to 2000. So as per its payback is more than 4 years. So this payback period says accept this one only. Because it doesn't consider what is happening later on. 6 and 7. Doesn't consider the life of the project. That doesn't consider the full life of the project. Is that clear? Tell me. Is it clear?
Yes.
There are so many other students sitting in the class. They are not responding. All right, students, let us take a 5 minutes break. We'll take a 5 minutes break. We come back. I will be taking short breaks during the class, boosters. So after 5 minutes, we'll be meeting and we will be talking about, make it 7 minutes. After 7 minutes, we'll be meeting and then we will be talking about duration. The next term, duration. Here, sorry, discounted payback first, then duration. Okay, so see you in the 5 minutes, 5 to 7 minutes.
Can you hear me, students?
Yes. Now, yes.
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 I don't know what is the issue with the airports.
Okay, now. So students, come here. The next is discounted payback. Discounted payback period. What is discounted payback period? Students, to eliminate this drawback, discounted payback period method came. It was introduced. Yes. Discounted payback was introduced. Now, so what we do is we calculate present value of the amount and then we calculate payback. For example, a project 0, 1, 2, 3, 4, and 5. 7,500 negative investment is there. Then is 2,300, 2,700, 2,850, and 2,350, and 3,370. So we calculate simple payback, which we have learned. So how we calculate? We make like that. These are the cash flows. These are the cumulative cash flows. Yes, this plus this. This plus this. Now you see here, 2-year complete. And 2,500 divided by 2,850. So 2.88 years. Or means, yes. Now, for example, cost of capital or discount rate is 10%. We have to calculate discounted payback. This is the simple payback of the project. Discounted payback. Discounted payback. Now, so what I will do, I will simply copy all these here. We have to calculate. Yes. So what we do is we calculate present value at 10%. What is the formula of present value, by the way? Present value is equal to future value into 1 plus r raised to power minus n. This is the old formula which you have been studying from F3, right? Just see here, future value into 1 plus r raised to power minus n. Here it is. So present value calculated. Now, cumulative cash flows column. From here we will make. Now, equal to this plus this. Equal to this plus this. Equal to this plus this. Now you see 3-year complete and 1036 divided by 1605. Here it is. So 3.64 year. That is the discounted payback of the project. Yeah, here we are. Is it clear? Tell me. Is it clear? Tell me, please.
Yes.
Everyone?
Yes.
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 Discounted payback. You see here, see, this was a simple payback. Yes. Now, next. Students, so you see here, one problem eliminated. One problem eliminated. But full life of the project is not still being considered. Yes, full life is not being considered still. So, students, how to consider full life of the project? Duration games. A new method. First of all, we will learn how to calculate duration of the project. Then I will explain the concept behind it. So you see here, this is a project. Same I take duration. It is also called Macaulay's duration. Macaulay's duration. Now, so students, duration. First of all, what we do is we start from return phase. Calculate, find return phase. What is return phase of the project? Return phase means phase of project. Means cash flows after, cash flows from the year when first positive cash flow occur. So return phase here, first positive is from the year one. So return phase starting from here. For example, cost of capital is 10%. So present value of cash flows at the rate of 10% equal to this into 1.1 raised to power minus this. So present value of cash flows. So total present value. Sum from here to here. So total present value of all cash flows. Total present value of all cash flows is here. Now just see here, weighted average. Just see here, everyone equal to this divided by 10161. I have done rounding off 0.2. Why I have done this? I have not linked the cell just to apply formula, just to establish a formula. I have done that. Now, here it is. Just see the formula, please. Here it is. And simply drag it. Yes, now duration. Sum from here to here. This is the duration of the project. This calculation, first of all, should be clear that how to calculate present value, total present value, and then this formula. Divided by total value, multiplied by relevant number of years. Yes. So students, weighted average time required to obtain cash flows from return phase of the project time to recover half the value of investment return. Yes, value. So method is given. I have done all that. Duration. So it takes, unlike payback, it covers the total expected return. Now this is explanation. If duration of the project is short relative to the life of the project, less than half of the life, 5 years. If it is 2, this means most of the return will be recovered in the early years of the project. Very important. If duration of the project is a large proportion of the life of, for example, more than 75% or more, it means most of the return will be recovered in the later year. I will do a question more. It means that duration is the best available method. Means when majority of the cash flow will occur, start of the project or end of the project. To calculate duration, the negative cash flow at the beginning of the project are ignored. I told you. It is calculated when they start to turn to positive. Let us solve. For example, another example. Example 2, duration. Just see here. For example, cash flows are here 0, 1, 2, 3, 4, 5, 6, and 7. Negative 4,000, negative 2,500 cash flows, negative 3,200 cash flows. Then a positive return started. That is 4,200. Then 5,500. Then negative 2,000. Once again got negative. Then is 6,600. Then is 7,300. These are the cash flows. Now for duration, then what we will do? We will simply, let me copy once again. Yes, we simply ignore the previous cash flows. This is the return phase starting from here. This is the return phase of the project. The cost of capital is, for example, that is 12%. Now, present value of return phase. Just see here, this into future value into 1.12 raised to power minus. Here we are. It is negative, yes, no worries. So total present value equal to sum from here to here. Now, weighted average. Just see here, equal to this divided by this amount, double 1 996 into number of year. There it is. Simple as that. So duration is equal to sum from here to here. 5.03. It is more than 70% of the life of the project. You see here, majority cash flows are in the later year of project. Yes, you just see here, later year, majority are here. And you have not to write this in exam, but sometimes they ask you to explain it, then you do it. Is it clear? Tell me.
Yes, yes.
Yes.
Good. Present value, yes, sure, of course. This is the present value. Just see it. Sorry, this is for the weighted average. Present value is here. Present value here. Excuse me. Good. What happened? Yeah, this is the weighted average. Okay. Now, this is the weighted average. Now, so we will proceed further now. So duration is, yes, of course, I will provide this Excel sheet, but for that, I will create a WhatsApp group. Everyone has to join that WhatsApp group. And every lecture, I will be sharing what Excel sheet there. Okay, I will be sharing the WhatsApp group link here. Okay, now, next. So duration captures both the time value of money and the whole life of the cash flows. It is also a measure which can be used across project to indicate bulk when the bulk of the value will be captured. Full value, it considered and time value as well. It's superior method. Disadvantage, very difficult. Industry does not understand. So calculation is given over here as well. You just see here. Modified duration, I'm not going to teach right now. Why? The reason is modified duration is the topic which has the discussion of bond, and that we will not be talking about that. Okay. Now, when the time will come, I will be discussing. So net present value. Just 1 minute. Just 1 minute. I'm just trying to get my coffee cup filled. Please, 1 minute. Now, so net present value. So net present value method is the method which is basically talks about, come here, let me type here. Yes. Now, so NPV, here it is. NPV, basically, I will type this definition over here. Thank you. So NPV is basically the method tells the exact impact of project on shareholders' wealth. Exact impact of a project on shareholders' wealth. Now come here. I will explain this sentence and the remaining everything will be explained. You will read yourself at home, then you will get understanding. Just see here. For example, I will take the same project. This is the project, NPV, net present value. Yes. Cost of capital is, for example, 12%. So NPV, these are the cash flows. So present value at the rate of 12%. This into 1.12 raised to power minus this. Here it is. Yes, here we are. Now, NPV is equal to sum here to here. Now, I will explain the definition in that paragraph here. Just focus. We invested this money in the first 3 years. We will get these cash flows. Then we will get these cash flows in the next years. Students, then we discounted these cash flows at required rate of return of investors. This is the investors' required rate of return. We know that. Means that we are paying interest and the return to investor out of it. We are adjusting time value of money. At the end, we paid initial investment as well. Still, we have now in our pocket this amount. Initially, we had, for example, 0 amount. We raised these amounts, invested. Then we paid return. Then we paid initial investment. And now, at the end, we have this, our wealth has increased by this amount. So that's why positive NPV means shareholders' wealth has increased by that amount. So that's what has increased or will increase, sorry, will increase because it is about future. So that's why we say accept the project. And negative means if NPV is negative, then it means we invested money, the people, we paid return, and when add the, for example, NPV is negative 1500. It means we are short of it. Even we could not repay all the costs and the initial investment. Negative NPV means that shareholders' wealth will it decrease by this amount. So that's why rejected. For example, in this case, for example, the company has 1,000 below. I will write here. This is the case 1. This is the case 2. For example, company has 1,000 shares, each trading at 95. So in the case 1, what will happen? Increase in share price will be theoretically. Practically things may different. Theoretically, yes, I increase in, oh my God, increase in share price. Share price, theoretically I'm saying. It should increase by, divided by, how many shares? 1,000. And share price should be 95 plus this, because of this project. Case 2. Increase in share price. That is this divided by 1,000. Yes. So 95 minus this. Sorry, what happened? Sorry, that it is already minus. Okay. 95 minus 1.5. Yes. 93. So this is how NPV accept only those projects which have positive NPV. So NPV leads to the maximization of shareholders' wealth. That's why NPV leads to the shareholders' wealth maximization. Shareholders' wealth maximization. Now, next. So you can read it yourself. Assumptions. Yes. Maximization of wealth. Cost of capital is the actual cost of the business funds. Investor is rational. This point is very valid. All cash flows, you see cash flows, this, they are reinvested. Assumption. This is basically when we do discounting or compounding. This is the basic assumption. The assumption is that all cash flows are reinvested at given rate. Now, what does it mean? It means that initially, just listen please. We invested 100 rupees for 1 year at 10% rate. I can explain it better over here. Just 1 minute, please. Yes, I hope you can. No, you cannot see. Just a minute, please. Here it is. Now, I hope you can see my screen. Now, students, I have $100 today. I invest it for 1 year. Rate of 10%. What I will get after 1 year? I will get 100 into 10%, 110. One thing is I withdraw 10 profit. The second is no, I reinvest 1 year. After 1 year, 121 means that the interest cash flows earned not being withdrawn. They are being reinvested at given rate, the rate which is there. This is the assumption of discounting and compounding. And the next year, if it is invested, it is 121 plus 121 and interest on that. Mean we are getting interest on additional 10 as well. Next year. Interest on 21 as well. Not on 100. Because next year invested amount is 100 plus 10. Is it clear? This is called compounding. Now, so compounding and discounting has this assumption. So is it clear? This statement is clear. What is meant by reinvested at a given rate? Tell me. Is it clear?
Yes.
Yes, sir.
All right. Come to the Excel sheet. Here. So in the NPV, calculation, the same is the assumption. The cash flows you earn every year, they are reinvested at discount rate or cost of capital. You reinvest them. Now, so in the NPV is a wonderful method. You can even change in the discount rate. For example, these are the cash flows. One more example. And discount rate, for example, or cost of capital is as follows. Initially, it is 12%. Then again 12% next year. Then it changes. It goes to 15%. Then 16%. Then falls to 14%. Then moves to 14.5%. For example, discount rates, it may happen. For example, it is 17%. For example, it is 10%. Suddenly it falls. Discount rate, I have written. So we can calculate NPV for that. So present value, just see here. Future value into 1 plus R. Rate discount rate is this. Raised to power minus number of year. Here it is. Simple as that. I applied the formula. Simple as that. So here is the NPV. So means even discount rate change that can be incorporated. NPV is cash flow based, covers the full life of the project. Consider the size of the project. 1 point. NPV is an absolute measure. The meaning of it. It means it tells the exact impact of a project on shareholders' wealth. That by how much amount, absolute means quantified. By how much amount the value of the project will increase. The value of the shareholder will increase. Yes. It tells the exact amount. Yes. It tells the exact amount. Yes. Now, to students, absolute measure, consider the size. Non-conventional cash flow means changing positive, then negative, positive, and we have done the example. You see here, positive, negative, positive, negative. This is not non-conventional cash flows are those cash flow where there are multiple negatives. Multiple negatives during the life of the project. So demerits, future cash flow are difficult. Cost of capital is difficult. It may change over the life. Yes. NPV says that maximization of shareholders' wealth. Non-profit organization don't seek that. Now, students, remember another point. Some assumptions. Cash flows, and these are drawbacks as well. Drawbacks. Cash flows occurring at the start of the year are considered to be in the previous year, and cash flows occurring at the end of the year considered to be in the same year. Assumptions these are. Now, so this is done. This is done. Now, students, we have to go for some adjustments. Let me open the course plan. What is next? Yes, what is next? Yes. AFM. So NPV is almost done. Yes, we have time. Can we discuss these two topics? Tell me.
Yes.
We have time. Why not utilize that? What do you say, everyone?
Yes.
Okay.
Yes.
Yes. It will benefit us, of course, in the upcoming classes. Now, so students, IRR and MIR, NPV, there are adjustments which I will discuss in the next class. Okay. So IRR and MIR, we will be talking about internal rate of return. Average and rate of return. Project's cash flows are discounted. Basically, it is return of the project. How in percentage terms. NPV is amount. This is the yield. The project will give this amount. This is what NPV tells. IRR tells how much percentage it will give. That. So, students, now just see here. So, internal rate of return, and you will be amazed to see that how easy IRR has become. I will take example. This is the project. Cash flows minus 3,400. Yes. 890, 1130, 1196, and 1087. Now just see here, we have to calculate IRR. And you will be surprised to see IRR is equal to IRR, this formula. How easy it is. I will explain, of course, what IRR is. This is how it has to be calculated. And we say if IRR of a project is greater than cost of capital, accept the project, because it is IRR is the return from the project. For example, cost of capital is 8%. So here we should accept it. Here it is giving 2% extra than the cost. You have to pay 8% and 2% with you. Now, let me explain it a bit over here on the iPad. Yes. Let me explain it here. Here actually what happens. You see what happens actually. This is discount rate. This is NPV. We calculate two NPVs and then we join them. This is the joining point. Here NPV is 0, you see here. This is IRR. Cost, you see here, basically, when we say a project has IRR of 10%, basically, we say that if we deduct this return from the project, when we discount cash flows, if we discount cash flows of the project using this, what will remain behind? Only initial investment. Hence, NP will become 0. When you minus all the return, it will be the initial investment. Simple as that. The definition you have studied that if cash flows of project are discounted at IRR, PV becomes 0. What does it mean? It is basically when you deduct the whole return, the remaining is initial investment. Simple is 0. IRR is basically return of the project. Is it clear? This point is clear?
Yes. Yes.
What is IRR basically? IRR is the return, average annual return. Now, have you noted it down? Should I proceed further?
Yes.
All right, now, next point. Students, IRR has advantages. Now, this is old fashioned. Okay, this is something old method of calculation. So, which we do not use now because we are now applying the Excel sheet to calculate. You need not to memorize this formula. IRR has some serious drawbacks, I am telling you. When we calculate IRR for such a project which has non-conventional cash flows, such, let me try to calculate. It may give over here. Not always, but sometimes it gives like that. For example, IRR. No, it has not given here. Again, means it gives two answers sometimes. Sometimes it happens. It has been verified. 19%, for example, and 30%. Or sometimes it says error, no IRR. So in that way, when it is calculated for non-conventional cash flows, these are non-conventional, when there are more than one time negative occurring during the life. This is a drawback. Sorry, let me close it. Yes. Here we are. So this is explained here. Now, so students, one more thing about IRR. It should have been there. Yes, advantages. Rational, very easy to calculate, easy to understand. Yes, it says cost of capital. More than that, cost of capital is break-even point. You have to pay. Consider time value of money. IRR is a relative measure. 10%, same issue of ARR. It doesn't tell the size of the project. Multiple IRR may occur. IRRs may occur. I have told you. And IRR can be confused with ARR. And this point is very important. Students, IRR. Yes, IRR assumes that, you see here, IRR assumes that cash flows are reinvested at IRR, that surplus cash flows. Now I will explain this point. This is written over there. Just I will going to explain. Apple, you know Apple? Everyone knows. Not Apple, Apple company. Now listen. Apple has multiple products. Do you know which product is the most profitable for Apple? Do you know? Which product is the most beneficial
iPhone.
and profitable for Apple? Yes. Which one?
iPhone.
Exactly. iPhone. Now the return they are earning from this project of iPhone. They reinvest it other product? No. At the same rate. Can they reinvest that surplus money at same rate of return? iPhone is producing abnormal returns. Very difficult. You know, Do you have you heard the name of Orkut.com? How many of you have heard? No one. Really? It was the first social site like Facebook. I made my account on it on 2006, right? It was by Google and it flopped. It was officially closed by Google, I think 2 years back. I think 2 or 3 years back. And you see, Facebook launched later on. Although it was launched in the country, but publicly, Facebook was launched a bit late. I made this account in 2006. It means it was present before. So you see here, even Google is unable to reinvest the money it is earning from Google, Android, YouTube, at the same rate of return other projects. I assume that surplus cash flows are reinvested at, which is not possible every time. Got this point? This assumption is wrong. The reinvestment assumption is wrong by IRR. Is that clear?
Yes.
Yes.
To everyone?
Yes.
Yes.
No. Let us proceed further. Students, because of this reinvestment assumption, then came modified internal rate of return. Which actually removed this drawback of reinvestment assumption and multiple IRR. Second was that multiple or no IRR in case of non-conventional cash flows. It was there were two huge or big, which we say, drawbacks. These two were removed by IRR. Yes. So just see here, MIR is also return of the project, and you can charge any reinvestment rate. For example, 2, 3, 500, 650, 780, and 990. Make it 800. And 105. Now, so for example, cost of capital is 10%. And they say these cash flows which are being generated, they will be reinvestment rate. You can have the same 10%. For example, we say 7%. Calculate MIRR. Yes. It is equal to MIRR. Just see here. Starting from here, comma. This is telling this formula, but in exam, you have to memorize how to put this. Finance rate is cost of capital. Reinvestment rate is this. %15%. So here it is in front of you, MIRR. So MIRR incorporates and removes both issues, means you can use any reinvestment rates. And there is no issue of multiple or no IRR. So MIRR. Yes. MIRR. Modified internal rate of return. So I have given the formulas. Now these have not to be used. Okay. So reinvestment. When it used to calculate this formula, when we were the back time when we were using calculator. So don't use these formulas now. So reinvestment produce a single answer, easy to calculate. Its decision is in line with NPV. Problems, not industry preferred method, and it is a relative measure. Now, students, I think we have done enough. Okay. Now we will be meeting on the next Sunday. And let me tell you, on Sunday, what we will be doing. We will be doing next the remaining annuity perpetuity. We will be doing NPV adjustments. And let me tell you, we will go for the risk and uncertainty as well. I'm telling you in advance. And if we have time, we will go for capital rationing as well. So this is the task for the next class. So do you think our pace is good? Tell me.
Yes.
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 Yes, sir.
Thank you. Thank you. So kindly enroll yourself before next class, and we will be proceeding with the next topics. Thank you for joining. God bless you. See you next Sunday, and I hope we will have a full 3 hours class next week. Take care. Goodbye. Goodbye.
Thank you, sir. Bye.
Thank you, sir. Bye-bye.
Thank you.
Thank you. Goodbye.
Bye.